All right, stop for a minute. Today we're going to talk about something very important, and it's about being cheap. Okay, you gotta be cheap in a lot of places in the world, but when it comes to option trading, being cheap isn't always the best bet. And I got this because we've got a question regarding this concept, and that is new to option trading, very excited to lose money. Kidding. I hope to make small wins here and there as I was buying very cheap options. I have just a few questions if I can get some answers from this community. All right, so Thomas asks this question at the beginning. I'm going to break some of these things down, but before I do, when you think about doing cheap things, okay, like back when I lived in Florida, sometimes you forget your flip-flops or this kind of thing, and maybe you're traveling, you want to buy some flip-flops. You're like, okay, I'm going to buy these flip-flops and I just need something quick and buy them for a couple bucks. When you buy cheap quality, they just fall apart over time. You might have them for a month, a couple months, and then they're like garbage, or they don't feel good, or you can't wear them for more than like 5 or 10 minutes, and then your feet start to hurt. So sometimes cheap is not always the best. And obviously there's a reason for that. They're cheap. Now you could have something in mid-range, mid-quality where you pay somewhat and it's decent for your personal needs, like, satisfying your needs. And then you could have high end, but then you might be overpaying or paying so much where the value or the benefit of it is very small. So when it comes to option trading, it's very similar. Cheap doesn't necessarily mean better. You have to recognize that as well. So when we look at option trading here, you're buying cheap options. You have to be mindful that cheap options, oftentimes you will lose on them because when they work phenomenal, right? When they explode, they work great, but you're going to lose maybe 7 out of 10 times, or whatever the statistic is, depending on your entry points, your profit taking points, the options you buy, the deltas, whether you use charts, and that helps. All these things kind of help your probabilities, but I'm going to show you why cheap options are just, you're going to fall apart with a lot of them. Okay, so looking at this, is there a need to own the stock before you buy a call option? No, there's not. You could just deal with the options. When I purchase a call option, is it best to buy to open? Yes, you're going to buy to open or sell to open. You're going to do something to open. So yes, if you're buying to open. And if so, do I exercise the contract if I'm happy with the price? You can. Most people don't. Most people, they buy the option. And then what happens is once you buy the option, and if it appreciates and moves in your favor, the contract value now is higher, you just sell the option contract to somebody else that actually does want to own the shares or whatever. If I purchase a contract for a put, do I need to own the stock? If I purchase a contract for a put, no, you don't. You could just buy the put. You don't need to own the stocks. In the same way, like if you buy a call, or you buy a put, you could just buy the single contracts. You don't need to own the shares. Any advice as a beginner would be much appreciated. I'm really excited and interested in becoming better at trading. I have $2,000 set aside for purchasing cheap contracts, experimenting, and that's what I'm comfortable with losing if it plays out that way. So there's a lot of people that'll give you their insight and input. You never know the quality of those inputs. So I'll share with you my insight when it comes to buying cheap options. Okay, so let's just say we're looking at a stock that's already reported earnings. So I want to get in there and just do Morgan Stanley. So let's say I'm buying a cheap option here and I'm going to go with 30 days. It's just kind of like a standard. That's why I'm doing this. Okay, so cheap options would be something way over here. And that means a delta. Here's my delta column. That's, let's just say maybe a 10 or 15 or 20 delta. So those are a lot cheaper. You're paying only $40 for these rather than paying like $100, $200 for something at the money. So I could buy this option for about 210 bucks, or I could buy the $50 one. You might say, well, why don't you get the $50 one? Well, the $50 one, the problem with it is here, this one is if I get movement and the stock actually moves, I make $50 roughly for every dollar move it goes up. And that is because of the delta. So I make $50 as it goes up. Now the downside is it does decay a little bit quicker, but if it moves, I get to make that premium. And even then, you might think it's a 50-50 shot. It's really not. I have to take into account the $2 premium. So it's at 104 plus the $2 premium. I'm going to break even around 106. So my probability actually is more around a 33%, not a 50%. So you can see there's my break even. It's around 106. Okay. Now, when we look at a cheap option, let's just say we're going to take a 110. It's a $45 option. It's a lot cheaper. So if we take this to a 110 and I analyze the trade, we're going to go to 110 and then we will say it. And then there, I'm only risking 45 bucks. The problem with this is I'm getting a bleed of theta of about $2 a day. This option is cheaper, but I'm only making $14. If this thing actually moves, I'm barely making any money to offset the theta decay. If you look at the theta to delta ratio, I've got about a 2 to 14, so it's a 7 difference, versus over here, I got a 3 to a 50. So it's completely different. Think about the ratio here. So it's like what, 12, 15? About 15, yeah, maybe 4, somewhere around there. So if we look at it that way, you've got a much better ratio here for if the stock actually moves in your favor. Whereas here, you got a 7 ratio. When it's over here, you got a better ratio where, yes, you get a little bit stronger of a decay, but if it moves faster. And the thing is that when you have a 110 call option contract, in this case, having this 110, you have to take into account that premium. So the break even is 110 plus that premium, 46, right? 110 plus the 45 gives me 1045 just to break even, which my chance of winning that cheap option is about a 111. So that gives me about only like a 12%, maybe 13% chance, somewhere around that range. So my point being is that doing cheap options, it's not bad, but there's a time and place to do these. You could do even more creative strategies with these. Like, let's say we use a cheap option by also selling a put option, and now I've got a little bit of a combo here going something like this, where even if the stock stands still, I still make money. But if it kind of pulls back a little bit, you still make money. But if it keeps going, you lose money. So, but the risk is much greater here in this case, obviously a little more advanced. But the point being is that this is how we can use single options for more of an explosive move if it happens. Just having a little bit of extra items on the side. Anyways, I hope that helps, answers that question. A lot of people want to get into cheap option contracts and doing things for cheap, but it's like cheap toilet paper. It just falls apart. You can't. It just sucks. So anyway, same thing here. Be careful, be mindful. If you're trying to do cheap stuff, it just, you got to understand what you're doing, because those cheap options, when they work, they do work well, but they're not always beneficial for new traders or beginning traders. You think and assume it's good for you because you don't have to risk as much, but the reality is your chance of profitability actually decreases. So be careful, be mindful, grab some freebies, worksheets if you like, and continue to learn. Anyways, I'll see you next time. Take care.